This is where we unpack trends that shape Africa's macroeconomic landscape to help our investors and businesses across the globe make better informed decisions. Today, we'll be discussing the outlook for 2026. With me, I'm joined by my two brilliant colleagues, Alan Mahinda, who is the head of global markets at Stanbic Bank Kenya, and Christopher Legalisho, who is the regional economist here at Stanbic Bank Kenya. We've got stable macros that are not just stable, doing very well. We've talked about growth doing well, currency stable, reserves going up, inflation's well anchored, local interest rates are coming down. How do you reconcile this environment where people on the ground don't feel this growth, don't feel this positivity? What do you think is the issue when you have very strong macros, but let me say very different micros?
I think the simple and straight answer is yes. The optimism that has materialized in 2025 has been rather surprising. I mean, if you take the way international markets have opened up to Africa, even in places where there's been sort of defaults being talked about or restructures being talked about, but now we see a flood of capital going there. I would certainly say this has been very, 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 very surprising. In terms of the other macros, for example, on the exchange rate, yes, I think when we started there, we kind of thought that maybe we might see some depreciation pressures on account of interest rates coming down, particularly on the local scene. But the shilling has shown a lot of resilience, and I think part of that is just down to how there's been significantly more global optimism than we sort of anticipated at the beginning of the year.
It's a much talked about discussion, probably the dinner table debate in many houses today in Kenya on why are people seeing things differently from what the headline macro numbers are showing. And I think it's a myriad of issues that has to be acknowledged around this. The first thing is that across the world, not just in Kenya, we have and policymakers have struggled to identify a solution for this. We have a mechanism or a way to create wealth, but to redistribute wealth, policymakers across the globe are struggling. And I think you still have that issue in many parts of sub-Saharan Africa. And we have to think about the tools to redistribute this income to avoid income inequality pressures rising. The other aspect I think that has to be factored in is the statutory deductions that we're seeing, which have dented real incomes, higher taxes, statutory deductions. And I think that impacts the middle class, upper middle class as well. And naturally, when they're impacted, I think the lower end of the income pyramid is also negatively impacted. And I'll give you a very simple example. When you see people tipping less at restaurants, that's a direct reality of this problem. The other very important aspect, which is again a sub-Saharan Africa-wide problem, is a lot of our informal sector, which is close to 90% of total employment statistics in many of our markets, largely relies on the agriculture sector to a big extent. And I think the agriculture sector still remains very small scale, very subsistent, and I think for that reason, very unproductive. And I think that also impacts a bit of the trickle down in terms of job creation, right? Because ultimately, if you talk about growth, you need to talk about inclusive growth. But when you talk about inclusive growth, you have to think about it via the vector lens of job creation. And so if you have headline GDP growth, that's very exciting, but it's not resulting into higher GDP growth, higher job growth, or higher real incomes, then I think that's where you have this disconnect of very strong macros and very poor micros. But for what it's worth, this is not a Kenya problem. This is something that we're seeing across sub-Saharan Africa.
Gibran, not many times do you get to ask an economist, especially when you're from the market side of things. But I just want to go back to the outlook you've just shared on interest rates outlook and saying it's a benign outlook. In your mind, and just looking at everything that is going on around, what's the biggest risk to that outlook?
Thanks, Alan. I think one thing that we have to understand is that we're still a very agrarian-driven economy. And so the weather is very hard to predict. And so we're always one drought away from higher interest rates or weaker currency where we import a lot of food. And of course, that is imperative that we think about that because, as we know, drought is an act of God, but famine normally is an act of man. So we always have to be prepared for a lot of these eventualities. And I think that's one of the very traditional upside risks that we think about for interest rates, not just in Kenya, but many sub-Saharan African economies that we look at. I think, Alan, the other aspect that we all have to be cautious about is the US Federal Reserve and their forward guidance on interest rates from there. I think for the better part of this year, there's been a dovish outlook, which I think has emboldened frontier market central bank policymakers to ease monetary policy conditions. And the baseline assumption that we have from our G10 desk is that the Federal Reserve will continue to remain dovish, will continue to see rate cuts. However, for any reason, if there is any uncertainty on the inflation outlook driven by tariffs or any other uncertainty on oil prices, for example, in a very uncertain geopolitical environment, I think that also potentially presents upside risks towards inflation. And I think linked to that point, if we have a deteriorating global risk environment for the factors that I just mentioned, that also potentially compromises your ability as a government in Africa or Kenya, for example, to raise external funding. And if your external funding envelope reduces, then you generally have to rely more on the domestic market. And that naturally also will place upside pressure on local interest rates. In April 2025, we saw the Liberation Day, as it was called, where tariffs were announced, and then subsequently were postponed through a moratorium, and also the actual amounts, absolute amounts, were lowered as well. But we do know that in such an uncertain global environment, for example, with the tariffs, any small event within a matter of days or weeks could impact global capital markets, and naturally, that could also infectiously impact our exchange rate. And if the exchange rate weakens due to global factors such as those, then I think understandably that could also put upside pressure on domestic interest rates as well. Thank you both for sharing these insights. Until next time, I am Gibran Qureshi, the head of Africa Region's Economic Research at Standard Bank Group. This has been Markets Unplugged. Please stay tuned.